are central banks over-tightening? Joining us now, Sarah Hunt, Alpine Woods portfolio manager. All right, Sarah, what say you? Are we at risk here for over-tightening?
Well, I think it depends on which risk you're talking about. To the equity markets, probably, because the equity markets have been assuming that we get to a certain point, we peak out, then we reverse course immediately, rates start to come down. That's also, I think, that's what's been holding up valuations. And I think that this concern about peak tightening is more, do we stay high enough for longer? Is another 25 or 50 basis points the problem? Or do we stay at 5% for a longer period of time? And is that the problem? And I think that's going to be the question that we're going to have to answer over the next 12 to 24 months.
Right. So how do you, in some ways, that feels like really binary. So how do you invest for that?
Well, I think that we have to, I mean, Ira Jersey made a great point just earlier. We have to make an assumption that the last 15 years were at post-financial crisis, where interest rates globally were held at zero or insanely low rates relative to history, that's not going to come back. And I think that what has been building into some of the valuation metrics on the equity markets is a return to that, because that of the recency bias, that's what's going to happen next. And I think that if it doesn't, there's going to have to be some sort of reckoning between where rates are and where equity valuations are. But it's a question of how fast that happens, or if the Fed can calm things down enough.
Right, and sort of that may be correct, but again, the timing is still an issue. So if you're going to just go with that, you'd be like, all right, I'm just going to go sell tech. But that maybe wouldn't have been so great over the last few months.
Well, I don't think that you have to just take that as sell tech, even though I do think that the expectation of lower rates is partially what's been fueling the ability for tech to continue to rally. You also have the whole AI trade. I think that the NVIDIA earnings and the reaction to that was somewhat telling that there may be a little bit of exhaustion in the market. So I think you're still going to get the growth out of tech, right? So you don't want to get out of tech entirely, but that broadening of the underneath of the market is something that we've been looking for. And you also want to see there are places where the valuations are not as high as they have been in tech. And I think that that's really what you want to focus on, because the multiple expansion has been ongoing, even with earnings essentially flat from last year. And the expectation that earnings are jumping another 12% next year, I think that's also possibly come into question.
So if I look at the S&P, we've had, what, 3.3% correction in the last month. Is that enough to like really consolidate? Or do you think we got to get a lot more here?
It's always tricky to try to figure out what the magnitude is going to be, right? Because the markets can always swing higher and lower than you think that they should. And it may be that we don't get the correction that everybody's looking for, because when people are looking for it, that's when it's harder to find. So I think the real question is what happens over the next coming months and the expectation for the Fed, and does that make equity markets have a lot more problems going any higher than here, or can they consolidate and stay here, or do we really have to see equity markets drop for people to feel like, okay, I now have a reason to get into equity markets for some of that cash that's been in bonds?
Okay, so if we are in a world, as I was talking about 2 to 5% on the 10-year, what are you supposed to do? Like, how long term do you make the best return in that environment?
Well, at the lower end of that range, I think technology can continue to perform very well. The question is, do we stay at that higher end of the range, and for how long? And what does that do, again, to some of those discount rates? So I think that there are opportunities in the stock market, and I think there's also opportunities right now in some fixed income. I mean, you see people talking about putting money there because there's a safety trade to some extent. But I think that there are some crosswinds globally in the economies. I mean, if you look at what's going on in China, for example, right now, that's the big concern about whether or not that gets exported to the rest of the world. So I think, you do want to have some caution here. So the balance of a balanced portfolio starts to make a lot more sense these days.
So what do you like then?
Well, there's certain areas that we like. I mean, I think you have to like healthcare just because of the generational trade that's going on. The world is getting older, right? So that's not going to go away. And I think that there has been a shift in manufacturing somewhat back to the United States. So that does help on the industrial sector. The question really is, I think that there's some concern about some of the areas like restaurants, leisure, where the spending has been enormous. Does that start to come down? And do we go back to more sort of normalized staples, as opposed to people running into the airlines are going to do fantastic for the next couple of years because people are going to keep traveling? I think it's really hard to figure out how long those trends persist, but there are values across sectors in different companies if you're looking for places where, there's still going to be some growth going forward.
Do you think that we're going to see bond volatility lead the equity market again, or is it NVIDIA leading bond market volatility? What's the relationship? Do you see that playing out?
Well, some of those relationships have been very unbalanced relative to history in the last year or so, and I think that that's the hardest thing to figure out what happens going forward. The idea that bonds can go up while stocks go up has been a little bit tricky historically. So the fact that we sort of seem to be settling out here at a place where people think that interest rates, even if the Fed does hike a couple more times over the next 6 months, or even one more time, that you probably have seen what's likely to be the top of the interest rate situation. So I think that then you start to see it come down. The question is, how much does it come down and how fast?
Right, and also sort of why they're doing it. We were talking about this in the last segment. If the Fed cuts to normalize, it's a very different situation than the Fed cutting because of a recession, which is typically what they do. But cutting to normalize is something, have we seen that at all?
I think it's one of those things that's a little bit like an economic unicorn. We love the idea of it, and we talk about it like it happens all the time, but it's not something that's very likely. And unfortunately, the problem of economic slowdown and the concerns that Kara Powell was talking about at Jackson Hole, which is the tight labor market, the stronger economy, even with higher interest rates, I think that leads people to think that, oh, I have to keep going because I haven't slowed things down enough. And very often those slowdowns start to come very slowly and then all at once. And so that's really trying to thread that needle. So I think that it would be great if we were cutting to normalize. I think the odds are more likely that we're cutting because there's some sort of a problem somewhere.
Sarah, before I let you go, jobs data Friday, going to be good, bad? What do you think?
I don't think it's going to be enormously different than expected. I mean, it sort of has been coming in not with the great higher props that we got early in the year, but sort of around trend or close to where the expectations were. I think that the slowing, if you saw a big slowing, I think that's going to get people to say, okay, we're done. Rates don't have to go up anymore. Now we see how long we have to hold it. If you got a really good number, paradoxically, right now, good news is somewhat bad news because it means that the Fed is going to have to keep going. We're back in that place where it would be really nice. I read something recently. It would be really nice if good news could just be good news and bad news could just be bad news. But it's been taken by the equity markets almost as the inverse relationship.